Traders, welcome back to the Independent Quants podcast, episode 12. I'm your host, Luis, as always. And in this episode, we're going to talk about what statistical methods we use to evaluate strategy performance. So if that's something that you don't know where to start, well, you'll have all those answers here. So the three things that we really want to touch on in this episode is why statistical evaluation matters in our strategy development, the key statistics metrics that we use to assess performance, and steps to apply those methods effectively. So why do statistics matter? Well, like I've mentioned in many of our other episodes, what we do as trader is it all based on probabilities. We need to be able to differentiate between luck and skill, right? Our skill is dependent upon our being able to assess probabilities. If we are just depending on luck to have our trades be successful or not, then we're just gamblers. And that's what we're not. We are risk managers. In order to be successful risk managers, we have to understand the mathematics of probabilities. And now, once we have that data from each one of our strategies that we're assessing, now we can compare strategies against one another. So that's another big reason why statistical evaluation matters in the grand scheme of things. And lastly, it's detecting overfitting. I've said in multiple of these podcasts, one of our biggest challenges is making sure that we don't overfit our strategy to what's happening in the markets. Now that can be from an overfitting of just adjusting too many parameters, the technical aspect of trying to fit a strategy to what's happening in the data, but it's also ourselves. It's understanding when we've crossed the line and when the data and your model is mimicking the market so much or your data so much that it actually can't generalize and trade the market that it hasn't seen yet. So in order to do all those three things, or all those things that I just mentioned, differentiate luck from skill, compare strategies objectively, and detect overfitting, we need to have a good, sound statistical base to be able to evaluate just the numbers. So what are those numbers? What are the key statistical metrics that we use to evaluate our trading strategies? Now, I'm going to go over a couple of them here that I think are universal, which is why I'm putting it in this podcast. But one of the big things that I want to make sure you understand is the exact metrics that you're going to need can vary dramatically from one strategy to the next. I'm not going to get into in this episode, what if you're doing a momentum strategy compared to a mean reversion strategy? Those are all going to have a lot of nuance in them into which numbers you're going to need to focus on. So in this podcast, I just want to keep it top level and just talk on those concrete ones that really don't matter regardless of what your strategy is. These are going to be important all the time. The first one, especially for us, is trying to implement an algorithmic strategy, is the maximum drawdown or the risk exposure that we get from our strategy. Why that's so critical is that we need to know given the data that we just went through, how much is our account potentially can be drawn down. Now that gives us several bits of information. One, tells us how large of an account we need to trade that strategy. If you have a strategy that has a $40,000 drawdown in the period of time that you traded it, you don't know, but right, this is all probabilities. But the soundest, most responsible thing you can do for yourself is to have a multiple of that drawdown for your starting account size. Remember where you probably used an arbitrary figure for the account size when you did that back test to assess, what the performance of that strategy was. The maximum drawdown now easily lets us translate that into a live account as to understanding how large an account you need. Now with that maximum drawdown, along with knowing what maximum account size you need, now you can begin to assess how much risk are you going to be exposed to by using that strategy, and is it even feasible? Because now if you need a much larger account size so that you don't experience a 20% drawdown, that's something that now you have to take into consideration. We get a lot of conversations of risk of ruin and how drawing down your account too severely can really just blow up your account and blow yourself up, right? You don't need to lose all your money to have a bad day, right? So maximum drawdown gives us that first glimpse of how much pain can is this strategy going to inflict on me? And am I willing to be able to endure that? Because there's the psychology of it all too. It's not just the numbers. Next is profit factor. Profit factor, risk to reward. I use those interchangeably because platforms use different names for the same thing. Usually if you go into something like NinjaTrader, they have a profit factor as one of their line items. I know TradeStation does as well. This is ultimately your risk reward. The higher, the better, right? This is telling us how much our gains are over our losses. Take all our profits over all our losses for that strategy. How you want the gains to be as big a multiple of that denominator as possible, the denominator being the losses. I'd say anything that is anywhere near 1 is just far too risky, because we're not going to get into too much on risk, or at least get into win percentage. Exactly. That's going to be our next one, but a little foreshadowing there. Maybe not foreshadowing. I just gave you the answer. But profit factor, the closer it is to 1, the higher your win percentage has to be. And now you have to look into matters of risk to reward. What does that look like? The higher that profit factor is, in a sense, your risk to reward, the more breathing room you have to be able to recover your losses and have this be a profitable strategy in the long run. So even if you have those drawdowns, if your profit factor is large enough, all you need are a couple of wins spread out through a certain period of time to recover those losses and then put you back in the black. So profit factor is a big, big one, and risk to reward, always big one. Next, which I kind of hinted at in that last one, which was your win rate. As professional traders, we don't focus so much on win rate. We focus on expectancy, but you can't have expectancy without win rate. So that's why I kind of tie them in both together. And this was told to me about the time that I first began trading, that professional traders focus on expectancy. I'm mathematically inclined, so I like that it had a formula associated to it. And what expectancy is, going with the math route first, is the difference between the products of your win percentage and your average winner and the product of your loss percentage and average loser. What the heck does that mean? You take your win percentage, let's say it's 70%, you multiply that by what the average size of your winner is, be that $200. Take 70% times, $200. And then on the other side, say, okay, what is your loss percentage, which is really just 1 minus your win percentage, right? So that example would be 30%. And then you multiply that by what your average losing trade is, and say it's $200. Calculate that out. That'll take you to a expectancy. That expectancy is a dollar value. The larger your expectancy, the better. Now, with everything, the higher your expectancy is, you're going to be balancing, right? Because your higher expectancy might mean a lower win rate with a greater risk reward. You're usually not going to get a great expectancy and a great profit factor. Those two are usually working against one another, but sometimes not. If your expectancy is really high, your risk to reward, your profit factor might be huge, but your win percentage may still be really low. You don't know, because your average winner may be astronomically large because of your profit factor. But all those things kind of hang in the balances for as how each one of those figures work. And what's beautiful about the expectancy is that it takes all those figures and kind of compresses them together. And what you're looking for is that dollar amount. For sure, you want it to be positive. But like I said, the higher, the better. And for yourself, you want to understand, is this strategy worth my while? If my expectancy is, convert that to a percentage of your account size and go, okay, this strategy can potentially grow my account 1% per whatever time frame you're looking at. That's a consideration for you. But those three factors right there, maximum drawdown, profit factor, and expectancy, those are 3 great metrics that you can use to compare strategies with each other. That's why I kind of use them as my base 3. And from there, I add on whatever other metric is important for the type of strategy that I'm actually backtesting or analyzing. Now, how do you apply these? The third step for this podcast. So to apply these, we were going to have a 5-step process. The first one being collect data. If it can be clean data, great, but it's collect data. I prefer to use data from the platform that I'm using. I know there are some quants out there that go through a lot of work to get clean data and clean market data. I don't go that far. Now, mind you, I am a self-taught quant, so I use the data that my platform has, right? Because my theory is if I'm trading on NinjaTrader or I'm trading on with Schwab or I'm trading with whoever I'm trading with, the algorithm is going to get the data that that broker is sending me. The strategies that I've been coding for the last several years don't require me to be pulling other data sources for it for them to execute. They've all been price action based. So cleaning data hasn't been that great a factor. Now, where this could be is maybe you're not just using market data. Maybe you're using alternative forms of data, satellite imagery, fundamental data points. You want to make sure that those are the proper data points that you need, and that they've been vetted, and that you're using the data that you should be using. So that's the first one. Collect the data that you need. Second is to run a robust backtest. I get into whole different podcasts where I talk on how to effectively do a backtest. If you head on over to the free mini course, I do a much more deeper dive than I could in this episode as to what a backtest is, how it's performed, and why it's valuable. But you want to make sure that you're using a platform that allows you to do your backtest effectively. For my newer traders, that's probably going to be the platform that your broker gives you. Again, these podcasts are not sponsored by any broker. I merely mentioned the ones that I've either am using or have used in the past, but something like NinjaTrader, TradeStation, those have their own backtest platforms as part of the software. And you can use those to run a thorough backtest. You can change parameters, make sure you really get to know that strategy. For step 3 is conduct out of sample testing. So the two platforms I just mentioned, TradeStation and NinjaTrader, allow you to do this very easily. And that is being able to have the backtest get trained on a portion of the data and then test it on another portion of the data. That is one of the best methods because then your model isn't being trained on the totality of the data. So it's not seeing the entire thing. So you can assess how well it's generalizing just the conditions that you're trading. In my case, it's price. How well is it, determining what the price action is after, making its decision point, because it's been trained on data that's different from the training data, or testing data, even though it's all one big lumps data. So the platforms that I talked on allows you to divide your data up in multiple ways in order to do that out of sample testing. Beyond the scope of this podcast. I mean, that can get pretty intense, but get familiar with your platform. Make sure that you're doing that out of sample testing, because that'll really get you to understand what your strategy risk parameters could be. Step 4 is a lot more advanced. It's performing Monte Carlo simulations. It allows you to run the backtest with randomized market conditions, and you'll be able to assess if it's weak or strong under different states of volatility in the market. As much as I say that it's advanced, I'd say to understand, but to implement, not so much. Even if you don't know what a Monte Carlo simulation is, if you understand so much that it is looking for different market conditions, the two platforms that I mentioned and many more have a Monte Carlo simulation setting that you can select within the backtest that allows you to run a Monte Carlo simulation, even if you don't know what the heck a Monte Carlo simulation is. That'll allow you to even do a better assessment as to how risky your strategy is, or the one that you're evaluating. And the last step is to make sure when you're optimize all that, using the out of sample and the Monte Carlo, whatever other methods you choose, that you do not overfit. For purpose of this conversation, overfitting is really just over tweaking parameters. That's where I see myself getting caught up a lot, and other folks is usually, and it's not just in trading. I mean, this is true for any of us that build models, be that for trading or for me in helping my clients build for their business intelligence systems. Overfitting is forever the bane of anybody that does statistical work. So you want to make sure that you don't over tweak your parameters, because there is a line drawn in the sand somewhere, or, it's fuzzy. You're not really going to know when you cross it. You'll know it that you've crossed it, but you don't know when you're crossing it. But when you do too many updates of the parameters, then the model that you just created is too unlike anything that you could find in the market, and it won't be able to generalize the data that it's getting, or the model won't be able to generalize the conditions well enough for it to be fruitful for you. So everything we just discussed there is how you can build a good base for yourself on how to use statistical analysis to build your models and build your trading desk. So big takeaways here is be sure to use multiple statistical metrics. No one metric yields success. You don't want to focus in on any one thing. All these statistics are dependent on one another. As one goes up, the other goes down. Depending on the strategy you're doing, you need to make sure that you're looking at the proper metrics that apply to it. I gave you 3 here that should apply across all strategies that you build, but always, always, always look at the correlation and look at the relationships between all the statistical metrics that you're trying to fine tune. Next is backtest with realistic conditions. I get into this in the mini course. You want to include slippage, commissions, and bad fills. Put all that into your backtest. That's a lot easier than it sounds. A lot of the platforms already have the tools for you to be able to just select the button and the platform takes care of it for you. So be sure to do that. Test across different market conditions. You want to make sure that your strategy is adaptable, and you want to know under what conditions it's not feasible for you to have that strategy going. And if you see that condition presenting itself in the market, you need to turn off your algo. And at the end of the day, keep it simple, right? The more complex models get, the more black box-ish they are, the harder they are just to troubleshoot and really understand what it is that you have and how to fix anything when it goes wrong. And then that's ultimately the big goal of all of this is to have confidence in the model when it goes live. And if you don't have confidence because you have no idea what the heck it's doing, that's a very big problem. So I hope you all found that real useful. Again, if you wanted to learn some more, head on over to the independentquant.com and sign up for our mini course, sign up for our newsletter. And I look forward to you being part of the community. Until then, thank you so much for listening. I'm Luis. Keep it green, everyone. Out.